Hey, a viewer recently commented about my bucket approach to my retirement and said that you've got, you know, 5 years in bucket one out of the stock market, CDs, I bonds, money markets, high yield savings accounts. And then you got another 5 years in bond funds. That's 10 years in safe assets to get you through a bear market or bad returns. That seems excessive. When has that ever happened? Okay, got this question. Hey, great. There's a lot to understand about managing your finances by yourself. I appreciate the question. But when has that happened last? Well, 2000 to 2010 was pretty darn ugly. So I'm going to read off a few returns. I'm not using my whiteboard. As you can tell, I'm on location. I'm not anywhere close to Indiana, but doing some reaction videos to the comments I got on a previous video. But if we look at the last nine, let's say 9 bear markets, and we're excluding the one from 2022, excluding the one from 2020, okay? Let's look at more historical ones that have kind of played out and we've seen the total impact of them. And I am going to link the article that I got these from. So if you want to click on these and see a little more information on the table, it's very easily. But if you go to 1956, there was a 21% loss. It went, and this is what's critical, it went from current highs to lows to fully returning in 1 year. Now, what people get confused is when they see, hey, that bear market lasted 4 months, that's the down. And when it returns at the trough, if they say it's been down went down 25%, when it starts to turn and is turned for a couple quarters, even if it's only gone up 1%, you're now in a new bull market, even though you're not even close to the net worth that you had previously. So you really need to look at time to recover to new highs again. And that's what this article does. So 1956, 1 year. 1961, 1 year. 66, a half year. These are all looking not too bad. 68, 2 years. 73, 6.5 years to return to new highs. 1980, 0.7 years. 1987, 2 years. 2000.com, I lived through that. I remember that one well. 6.2 years. And 2007, 4.7 years. So the highest one I mentioned was 6.5 years. But, think about your bucket one and bucket two. Let's use the .com. Let's start in year 2000. So you go down and reach new highs after 6.2 years. Well, that started in 2000, and you're almost to 2007, and then it went down again for another 4.7 years. So yes, you did come back up, but you almost instantly went back down. Some people call this the lost decade. So that is almost 11 years. 11 years the market was down before it recovered permanently for to new highs. So your bucket one and two were completely depleted, got back up to new highs, and just about the time you're thinking about refunding your buckets, it went down again. And the second time it went down by 57%. So huge impact. So 2 times in the last 50 years, we had painful stress on any bucket approach. Any bucket one and bucket two money was painful. The worst one was 2000 to 2010, let's say, about 11 years. And then we had one in the 70s that was 7 years. So my answer to the question is 10 years excessive to manage through a bear market? No, it happened in the last 20 years. And, really had a second one There were two of them that were really stressful in the last 50. So what can happen? And really, what risk do you want to take, especially when you're retired? You could have a natural cycle that, bear markets happen. I think I saw a recorded every 5.5 years on average it happens. Most of them are small and come back. But what if you have one that's painful, like 40%, then you have another black swan event before it has a chance to recover, goes down another 40%, you're in rough shape. Those numbers may be dramatic, but going down 10 years has happened recently, and being down 7 years has happened in the 70s. So, if you can in your retirement plan, it's not 10 years is pretty likely to happen during a 35 year retirement. Be careful of recency bias. If you look at, hey, since 2010, the market has gone up and we've had this COVID drop, which was, like a month. And then we've had, 2022 and it came back in 2023. Hey, bear markets always come back that fast. Well, not so fast. You don't want to be facing that challenge when you're 75 that you had two bear markets back to back. And I'm telling you, I modeled my buckets starting in, say I retired in 2000, and they worked, but it was bloody, it was ugly, and I guarantee it would have been stressful to live through that. So that is one of the reasons I took my buckets from a target of 4 and 4 years in bucket 1, 4 years in bucket 2. I ramped it up to 5, really because I could. And I'm not saying that's required, but I'm not chasing returns with this money, and my plan solves very well at this level. And, believe me, I don't have a lot of bonds. That's one of the things that came across in the video. Sometimes people thought I was heavily invested in bonds. My bond fund is like, it's under 10%. I know without looking at the numbers, I know my total bonds are under 10%. There are natural cycles, and you got to be careful. Black swan event. Black swan event being something like COVID comes in, or a war, or something. 9/11 was a black swan event that happened. Also, I'm just talking about bear markets, which is a 20% decline. What about a 19% decline, a 10% decline? All these other declines that randomly happen interspersed between these years, what does that do to your portfolio? So the market goes down 15%, you're eating out of bucket 1, then you get a couple years back, don't quite fill bucket 1 up again, and then you end up with a bear market catching you when bucket 1 or bucket 2 is stressed. So be careful looking at just bear markets. Bear markets can be 1 month, like in 2020. I saw one that was 31 months. That's, so people say, hey, a bear market lasts 31 months. That's all I need to have in safe assets. No. That's the trip down the curve. You've got to look at the trip back up the curve because you're still pulling out of your safe assets during that time. So wanted to make sure I covered that. And 10 years seems like a long time, but asking me when was the last time that happened? Wasn't that long ago. This is Joe out.